Classical economics. Classical economics emphasizes free markets, individual self-interest, and minimal government intervention as key drivers of economic growth. It posits that when individuals pursue their own interest in a free market, optimal resource allocation and economic prosperity are achieved. For instance, Adam Smith's concept of the invisible hand illustrates how individual actions can unintentionally benefit society as a whole. Keynesianism. Keynesianism, inspired by economist John Maynard Keynes, advocates for active government intervention during economic downturns to stimulate demand and reduce unemployment. Unlike classical economics, which relies on market mechanisms, Keynesianism suggests that during recessions, government spending can boost demand and stabilize the economy. For example, Keynesianism policies such as public works projects were implemented during the Great Recession to create jobs and stimulate economic activity. Marxism. Marxism, based on the works of Karl Marx, critiques capitalism and advocates for a classless society where the means of production are owned collectively. It views capitalism inherently as exploitative, with workers being alienated from the fruits of their labor. Marx's analysis suggests that over time, contradictions within capitalism will lead to class conflict and revolution, as seen in historical examples like the Russian Revolution. Neoclassical economics. Neoclassical economics focuses on individual decision-making within markets and emphasizes the role of supply and demand in determining prices. It assumes rational behavior and efficient markets, where individuals maximize utility given constraints. For instance, the law of demand states that as the price of a good decreases, the quantity demanded increases, holding other factors constant. Monetarism. Monetarism, associated with economist Milton Friedman, highlights the importance of controlling the money supply to stabilize the economy. It argues that excessive growth in the money supply leads to inflation, while insufficient growth can hinder economic growth. Monetarists advocate for central banks to use monetary policy, such as adjusting interest rates, to manage inflation and stabilize the economy, as demonstrated during the periods of hyperinflation in countries like Zimbabwe. Supply-side economics. Supply-side economics focuses on policies that promote production and supply to stimulate economic growth. It advocates for reducing taxes and regulations to incentivize investment and entrepreneurship. For instance, proponents argue that lowering corporate taxes can encourage businesses to expand, leading to job creation and economic growth, as evidenced by the economic reforms during the Reagan administration in the United States. Institutional economics. Institutional economics examines how institutions and social norms shape economic behavior and outcomes. It emphasizes the importance of institutions like property rights and contract enforcement in facilitating economic transactions. For example, Nobel laureate Douglas North's research highlights how institutions impact long-term economic development, such as the role of property rights in fostering investment and innovation in developing countries. Behavioral economics. Behavioral economics integrates insights from psychology into economic analysis, recognizing that individuals may not always act rationally. It studies phenomena like cognitive biases and social influences on decision-making. For example, the endowment effect demonstrates how people tend to value items they own more than identical items they don't own, influencing economic decisions such as pricing and consumer behavior. Austrian School of Economics. The Austrian school emphasizes the subjective nature of value and the importance of market processes in coordinating economic activity. It focuses on the role of entrepreneurship and the knowledge problem in economic coordination. For example, Friedrich Hayek's concept of spontaneous order suggests that complex social systems can emerge without central planning, as seen in the development of market economies. Post-Keynesian economics. Post-Keynesian economics extends Keynesian ideas, emphasizing the role of uncertainty and financial instability in the economy. It critiques neoclassical assumptions and highlights the importance of effective demand. For example, Hyman Minsky's financial instability hypothesis suggests that periods of stability can lead to excessive risk-taking and financial crises. as witnessed during the 2008 global financial crisis. Development economics. Development economics studies the economic, social, and political factors influencing economic development in lower-income countries. It examines issues like poverty, inequality, education, and industrialization. For example, the Solow model explains how factors like capital accumulation and technological progress drive economic growth over time, highlighting the role of investment in development. Environmental economics. Environmental economics analyzes the interaction between economic activity and the environment, addressing issues like pollution, natural resource depletion, and climate change. It explores policies like carbon pricing and pollution taxes to internalize environmental costs. For example, the tragedy of the commons illustrates how unregulated resource use can lead to depletion, highlighting the need for environmental regulations. International trade theories. International trade theories explains patterns of trade and the gains from trade between countries. They include concepts like comparative advantage and factor endowments. For example, the Heckscher-Ohlin model predicts that countries will export goods that intensively use their abundant factors of production, leading to specialization and trade. Labor economics. Labor economics examines issues related to the labor market, including wages, employment, and labor force participation. It explores topics like human capital accumulation and the impact of technology on jobs. For example, the labor-leisure trade-off illustrates how individuals allocate their time between work and leisure, influenced by factors like wage rates and preferences. Game theory. Game theory analyzes strategic interactions between rational decision-makers. It studies scenarios like the prisoner's dilemma and oligopoly competition. For example, the Nash equilibrium concept explains situations where no player has an incentive to unilaterally change their strategy, illustrating the concept of stable strategic outcomes. Public choice theory. Public choice theory applies economic analysis to political decision-making, examining how self-interest individuals influence government policies. It explores concepts like rent-seeking and regulatory capture. For example, the median voter theorem predicts that politicians will cater to the preferences of median voters to win elections, shaping public policies. Neuroeconomics. Neuroeconomics investigates the neurobasis of economic decision-making, using techniques like brain imaging to study how the brain responds to economic incentives. It explores topics like risk aversion and intertemporal choice. For example, studies have shown that the brain's reward system activates when receiving money, influencing economic behavior and decision-making processes. Economics of inequality. The economics of inequality analyzes the distribution of income and wealth within societies, exploring factors like education, taxation, and social mobility. It examines the impact of inequality on economic growth and social cohesion. For example, research has shown that countries with lower levels of inequality tend to have higher levels of social trust and economic stability, highlighting the importance of addressing inequality for overall societal well-being. Money and banking theories. Money and banking theories study the role of money, banks, and financial institutions in the economy. They explore concepts like fractional reserve banking and central bank operations. For example, the money multiplier explains how an initial increase in bank reserves can lead to a larger increase in the money supply, influencing monetary policy decisions. Behavioral finance. Behavioral finance applies psychological insights to financial decision-making, investigating phenomena like herding behavior and overconfidence. It examines how cognitive biases affect investment decisions and market outcomes. For example, prospect theory explains how individuals weigh potential gains and losses differently when making financial choices, impacting investment strategies and risk management practices.